Welcome, class, to the first lecture on the Great Recession of 2008. So let's talk a bit about uh, where we are today. The banks have really recovered from the recession. The housing market, not quite yet. Individual homeowners, I think there's still a lot of suffering out there. The unemployment rate is still pretty high. It's at about 6.2% now. So we're still faced with a lot of problems as a fallout of the 2008 economic crisis. And so I think it's worth talking about. In particular, young people's unemployment is quite high. I hate to mention that, but it's true that unemployment for young people is at historic highs. So we really haven't recovered completely from the crisis of 2008. So it's worth getting some context on it. Why did this happen? Why did people have to go through all this suffering? Well, let's start back with something that was very basic to the crisis, and that's home ownership. Now, President George Bush in the early 2000s decided, you know, I think it'd be great if everybody could own a home. And so President Bush encouraged Alan Greenspan, who was the head of the Federal Reserve, to actually keep interest rates really low so that mortgages would become readily available. In addition to that, the people who offered mortgages, the banks, were encouraged to offer mortgages to everyone, and there were new mortgage instruments. There were loans that were actually called Ninas, which were no income, no assets. In other words, you didn't have to show that you had any income or assets in order to get a mortgage for a home. So that was really kind of dangerous lending practices. And the people who got those kinds of loans were people who were really vulnerable to be, late on their payments or to default on their payments. Okay, so you have this situation developing in the early 2000s. And then in addition to that, you have a new circumstance in the world, and that's that there's all kinds of money that's been created between the year 2000 and 2007. About 60, the amount of money invested in the world increased from about $35 trillion dollars to about $70 trillion dollars. And so that new money had to go somewhere. The investors worldwide who wanted to make those investments, they had to find places where they could invest that money where they felt it was safe. And what's more safe than these mortgage instruments, which were actually offering really nice high interest rates. And so what develops then is a market for these bad mortgages, and they're called CDOs or credit default. Uh, collateral debt obligations, CDOs, and there's the CDSs. That's another thing. That's a credit default swap. We'll talk about that in a minute. And so these CDOs were sold and became a part of the marketplace. And so what happened then at that point is we developed a housing bubble. I mean, it was a housing bubble, like like these bubbles that are blowing around me. A housing bubble. So uh, we had a housing bubble, and what happened then is housing prices went up and up and up beyond their value, beyond any reasonable value for these homes. And so people borrowed more money against the houses. And the minute trouble started with some of these mortgages, and the housing market began to collapse, and the housing bubble burst, just like these bubbles are popping off to the side. So that's one of the main reasons that the 2008 Great Recession happened. Now so that's the housing and the housing bubble side of this story. Now let's talk about the credit default swaps. Now this is a very innovative and strange financial innovation. It's called a derivative, and the credit default swap essentially allows investors to bet on the market. It allows them to actually to place a bet on whether or not another company will fail or succeed. And so that essentially what they do is they buy an insurance policy from an insurance company like AIG, which was the largest private insurance company in the United States at the time, and sold these credit default policies, credit default swap policies. And so banks would buy policies on one another. They would buy a policy that predicted that uh, the, the other company that they were buying it on would fail, and then they would buy another one that said that the company would succeed. So these banks would buy these credit default swaps, and no one knew what the other guy was betting on. And the biggest problem is that these were private uh, exchanges, private contracts, and no one knew how much money was in these. It turns out there were trillions, probably $60 trillion in credit default swaps in the United States alone. It's an enormous amount of money, almost equal to the that global pool of money that we talked about before. And so the credit default swaps, which were essentially kind of a form of gambling, became a very dangerous financial practice. And the problem was that once one company failed, then another company would fail, and pretty soon AIG, the insurer of all these credit default swaps, the company that had to pay out if another company failed, they were into it up to about $400 billion, and the total value of AIG was about $80 billion. So there was an enormous liability, and eventually, of course, the U.S. government has to bail out AIG. So that's another problem with the financial system at this point. Is the credit default swaps are definitely part of the problem. Now, so what you have is the housing bubble bursts, and then you have all of these secret deals, these credit default swaps, and companies start to fail, and so the bill for credit default swaps gets very high. The truth is that some of the banks continue to make a lot of money off of these credit default swaps because if they bet right, then they get a big payment from AIG. So it wasn't like everybody lost money in this. The credit default swaps allowed some people to make quite a bit of money. And so the stock market began to decline. Uh, some of the banks which had invested in credit default swaps or had invested in these collateralized debt obligations that had all these bundled mortgages, those companies began to fail, and then the companies that invested in those companies began to fail. And that's how Lehman Brothers actually fails. In September 2008, Lehman Brothers actually goes under. And the federal government, for a short moment, considers saving Lehman Brothers, but then just lets them go. And this is when the crisis really comes to a head. And what happens in September 2008 is that Wall Street and the financial markets in the United States go under a panic. So the class is called Bubbles, Panics, and Depression. Well, we're in September and October 2008. We are four square into a panic because what has happened is commercial paper has dried up. Now, what's commercial paper? Commercial paper is actually the loans. There's essentially overnight loans that most of the large corporations have to take out in order to do day-to-day business. So let me give you an example. Let's say GE, which is of course a large, highly successful corporation, has to make its payroll on Friday. And in order to do that, they don't have cash in the bank to make that payroll. So they have to make a short-term loan to make that payroll. That short-term loan is done on Wall Street. It's done with another bank, and it's called commercial paper. It's a loan for maybe 30 days or 15 days, and the percentage, interest is very low on these loans. So it kind of oils financial capitalism in the United States, the commercial paper market. Well, what happens is the folks the banks who are loaning out commercial paper, some of the loans that they are giving out go to corporations that fail. And so now they've lost money on their commercial paper. So they decide we're not going to do this anymore. And so they literally stop offering commercial paper. And there's a moment in October 2008 when there's some concern that the financial system in the United States could actually seize up, that all of a sudden uh, large corporations would have to lay off millions of people because they couldn't get commercial paper to pay them. Okay, so this is really a serious problem. Now, eventually, what happens is the Federal Reserve actually takes over the commercial paper market, and so really saves the commercial paper market. They become essentially the loan maker of last resort for corporations who need short-term loans, and so the commercial paper market is saved. Okay, so we're at the top of the crisis of this, and the stock market has declined in the range of 35 to 40%. People are losing fortunes, retirees or people close to retirement are losing all kinds of money. And so we're in a big crisis. The government steps in and they actually they bail out the banks, and then they also they buy GM. They essentially bail out GM, and they also put in place about so the bank bailout is about $700 billion, and then the financial stimulus package is about another $700 billion. Economists estimate that we lost about $1.5 trillion in the meltdown. Problem is 7 billion plus 7 billion. That's 1.4 trillion. 700 billion. 700 billion is 1.4 trillion. It's not even close to what we lost. Um, and so I'm sorry, it was over $2 trillion that we lost, and so that you put that amount of money together, and we're still not close to the amount of money we lost in the crisis. And so what happens is the economy takes a long time to recover, and that's part of the reason, because we didn't put enough money, the government and the Federal Reserve together didn't put enough money into the economy to replace the money that was lost. It's a real simple kind of equation. That much money flows out of the market that quickly or is lost in investments or stock losses or CDOs or CDSs, then you have to replace that money in order for the economy to come back. And this was not a normal business cycle. This was a very serious economic crisis. But the good news is that the government did act and did replace a good portion of the money that was lost, unlike the European financial crisis, which turned into a debt crisis. And instead, the Europeans pursued austerity policies. And you look at where Europe is at right now, and they're still struggling because of the austerity policies, because they didn't replace the money that was lost there. Okay, that's really important. Okay, so now, uh, why was this allowed to happen? Because it seems like this economic crisis could have been prevented, or I mean, why did the banks make these risky loans? Why did other banks buy this risky these CDOs, these bundled mortgages? Why? Well, part of the answer is because they could. And the reason for that is because the federal government and the regulators in the financial industry fell down on the job. In the late 1990s, the federal government passed laws that said that uh, the uh, the the financial industry regulation was too stringent and had to be pulled back. And so regulators did less regulating. In fact, there was one office called the Office of Thrift Supervision, which really didn't do any regulating at all. And the other thing is that banks were allowed to choose their regulator. And so everybody chose this small federal office of regulators, the Office of Thrift Supervision, and there wasn't much regulation. So that's part of the reason why the CDOs came into play, and and why these bad mortgages were made. Now the other thing that happens is the federal government passes a law in 2000 saying that credit default swaps will not be regulated by the federal government. They're going to be completely unregulated. So this is, in a way, it's kind of inviting this kind of a disaster, It's kind of the Wild West of capitalism, really, of this new kind of financial capitalism. So you've got all of these problems and that develop because the federal government and the federal regulators do not do their job. Okay. Now there's one other part of this, and this is the credit ratings agencies like Standard and Poor's and Fitch's and Moody's. These guys, if they had been doing their jobs properly, they would not have rated these CDOs, especially, as highly as they did. A lot of the CDOs, the collateralized debt obligations, these bundled mortgages, were ranked at AAA, which is really the best ranking you can get. They were ranked at AAA because the credit ratings agencies had no experience with them. They really didn't know how to rank them. And so they ranked them uh, as good because they had been told that the repayments were fine and that some of the basic numbers looked pretty good. So they rated them quite highly. And this was a problem because these were very toxic assets that were bound to produce defaults and failures. Okay, so you have a lot of different problems producing this financial crisis. And unfortunately, the, the federal taxpayer was really the payer of last resort in this, about 1.4 trillion, and that, as I said, didn't even cover the whole of the financial crisis. But fortunately, we have recovered somewhat from the financial crisis. One note, the CDSs, the credit default swaps, they're still there. The federal government did set up a public exchange by which uh, these credit default swaps are exchanged for the United States and for Europe. There are other parts of the world where credit default swaps are still unregulated. And some economists estimate, we don't know how much money is out there, but some economists estimate that $1,200 trillion in credit default swaps now are in existence in the world economy. I don't know if that's reliable, but if it's true, that's an enormous amount of risk. The government has, of course, responded by prosecuting a few people in the crisis. They've punished a few people in the crisis. There was a recent settlement in 2014 to make Bank of America pay about, I think it's about $20 billion to as recompense for these bad loans and such. So there's been some of this, but there hasn't been nearly enough of holding the banks to account. And this brings and in comparison to the Great Depression, when some of the same stuff happened, of course, the response of the federal government was much more vigorous, and these financial the financial leaders were prosecuted if they had done illegal things, and so a much different situation. And so we're still at some risk. And so I think that's all I'll say for now. Okay, thanks very much.